literally just recorded this lesson and I didn't hit record. So let's go over this one more time. So brokerage platform features, trading platform, that is going to be, I use NinjaTrader with Rhythmic. That is how I'm able to place orders. Charting software would be my trading view. That's where I put my indicators, mark up price, and do all that research over there. Margin and leverage. So leverage 1 to 50 is normal here. You can have up to 1 to 500. I swear I saw 1 to 1,000 one time. Can't remember, but don't do it. 1 to 50 is more than enough. That way you don't get in trouble and blow your account in one trade. And your margin is a loan provided by the broker to the trader, allowing them to take a larger position than they would otherwise be able to with their own funds. And you can see they work together. Spread is the difference between bid and ask price of the buyers and sellers. Stop loss. Now, the way to think about stop losses is like a bodyguard or a security guard. You're paying them whatever you're willing to lose to make sure you protect your capital and you don't lose your entire money that you have in the position. So think of it as a protection fee. Don't think of it as I lost this money. You signed the contract that said, hey, I will pay you this much to protect me, because if price goes this way, I don't want to lose any more. This is as much as I want to lose. And then take profit is the opposite. You're telling the broker, hey, this is all I want from the market. Price went to where I thought I was going to go. Give me my money. I don't care if it goes any higher. And I certainly do not want to be partaking in it if it goes any lower. So close me out. Give me my money. Done deal. And order execution, that is when you're placing your trade. So depending on how fast your broker places it and the spread, you may get filled in at a price different than the live price. Now, order books, you can see the buys and sells of the markets, all the orders. But for me, I don't really use this. I think it's a little confusing. People use it. Some traders that I'll watch their live streams, sometimes they're using it. I trying to understand why they're using it. I just don't get it. Maybe in the smaller stock market, small cap stocks, all that stuff, maybe it does make sense if there's a big buyer at certain levels or big seller. But for these big markets, liquidity comes and goes. It's going to go through it, up it. It takes a lot of capital, I think, if you're going to even stall it. And even then, I don't think you really can, because the markets are protected. Imagine if someone with a lot of money, billions of dollars, comes from a different country and tries to crash our markets because they're selling everything. So think of it like that. I don't really think the order books are that helpful. Just get some indicators to show you the bias, the direction, and then price action to get in on your entries. So newsfeed, I'll show you in TradingView. There's 2 different ways to get newsfeed. You could go to the news. You'll see all the articles for the instrument you are on. So we're on the E-mini S&P 500. And then the calendar. So I only have US calendar date, so March 10th. We got non-farm payroll and unemployment, so big day. I don't think price is going to move too much tomorrow. I think we're just going to kind of mellow out. We had big movement previous days, so that's the type of news you want to keep track of. You don't see this and say, oh, this is whatever, it's blah blah blah, I'm gonna sell it for the market. No, just let price play out and then adjust. Don't get in before, don't ride through it. Just let price settle and show you the direction it wants to end up going.